welcome back to another episode of Reinventing Finance. I'm very happy today to have Viola with me on my virtual podcast. Viola, how are you today?
I'm good. Thanks, Nick, for having me. It's a pleasure being here with you. You know, I've been listening on Spotify to your previous podcasts, so I try to come in prepared. So it's really a pleasure to be with you here today.
Thank you so much. And it's always weird because I only see this side of the podcast, and it's obviously great when people kind of listen in and feel that their valuable time is you can spend on what's happening in insurance and in finance, and that we can kind of contribute to that. So thank you very much. That just made my day. So you are business development director at Ageas for new growth engines. Care to elaborate?
What's in a name, right?
What a name! No.
Yeah, you see these very interesting positions. So I'm not an evangelist, right? But so we have a current running strategy called Impact24 up until 2024. And as part of this strategy, we set out 3 areas that we would like to innovate in. And those are specific areas in product, service, or distribution innovation, mostly around health, protection, and B2B2C partnerships. So those are the 3 topics that we identified as new growth engines. And those are the 3 bigger projects that I've been leading for the past 3 years at Ageas group level, obviously together with some of our markets where these innovations make the most sense. We are not trying to sort of boil the ocean and innovate everywhere, but trying to look for meaningful experiments in markets where it makes sense. So that's basically behind new growth engines today.
So
going forward, yeah.
Sorry, go ahead.
No, I just wanted to add that you might have seen we launched our new strategy last week, Elevate 27, so running up until 2027. And so here in this strategy, we build in a bit some of the learnings we had over the past 3 years, also including innovation engine that I'm leading. And the new strategy will give me a bit of a narrower and deeper scope. And I will be focusing mostly on distribution innovation around B2B2C partnerships. So that's everything beyond the really traditional channels of banca agency, broker, all the B2B2C relationships with digital platforms of all kinds, if you want. So that will be going forward, my focus. Perfect. Is that any more clear?
Well, let's see. I'll try to unpack a few things. So you've said originally 3 growth engines: health, protection, and B2B2C partnerships. When you say protection, is that P&C products, or as opposed to health, or what do you consider protection, or just generally insurance protection?
No, good question. So again, what's in a word, right? So protection, we have looked at it as mostly life products of the non-reimbursement type, right? Where we see a lot of potential innovation, for example, to review the way you underwrite, how inclusive you are. Can you use third-party data or your own data to be more inclusive in your underwriting and offer insurance for segments beyond the regular customer base and so forth? So these would be typically, a term life, accident covers, a credit life, really products that you would generally find on a digital sales channel, also in B2B2C. So you see there's quite a big overlap there in terms of go-to-market with a product via a specific channel.
And that kind of leads to my second question, because 2 are kind of coming a little bit from the product service angle, and B2B2C is a distribution angle. And what is that? How do they compare and contrast? What's the overlap? If you could just elaborate, because I think it's a natural tension, and it doesn't have to be a problem. It's just a natural tension of how potentially traditionally insurance companies have kind of set up their product and go-to-market engines or
Yeah.
setups?
So I think it goes back to our heritage, right? So Ageas is active in Europe and Asia, and in most of the markets we have a quite a significant bank assurance channel. So I think you just had also another episode on Banca 2.0, which was also quite, while I was listening, I was nodding a lot, and some cases I was like, yeah, I'm not sure about this, but okay. But you also know the background, right? So bank assurance comes with bank type of products that are basically created to support primarily in-branch sales for banca personnel, mostly linked to banca products, right? And that is now transforming into a digital banca value proposition or an O2 or a hybrid type of value proposition. But the products are not that different, if you want. It's still, you are trying to link the value proposition to what the bank is offering to the end customers. You still need some kind of synergy to make sense of it. But next to our traditional banca channels, we also have in some markets, not everywhere, agency and broker relationships. And there again, those are very different, or can be very different from a product suite perspective, right? So the products we have on the shelf are a bit protection, but often linked to a banca product, are a bit of savings that would require a bit more of advisory, or towards more affluent customers, a bit more complex products around health or critical illness, potentially with these in riders as well. So you have the more traditional type of product setup. And what we have been experimenting with in the past 3 years is nothing wrong with these products, but going forward, how can these products be a good basis for a digital sale? Can we simplify some of these products? Can we pre-underwrite to make the onboarding process a lot more smooth to the customer? Can we use data from platform data or our own data to take out steps in underwriting without compromising on the quality of the portfolio? So that's a bit where, for me, the protection engine and the B2B2C come together. I hope that answers. Yeah.
It, as any good answer, it does, and then it leads to further questions.
Yes, that's good.
So just one thing I wanted to note, because you mentioned that in passing by, but I found this very often for companies for whom B2B2C or embedded insurance or affinity insurance, for the sake of this, let's just assume it can be similar. That they almost assume, okay, I now have this product that works for me good in an agent or broker channel, and please find me an embedded channel that the same product also works for, which is usually not how it works.
Yeah.
I mean, even in agent and broker channels, the products are not the same.
Yeah.
The delivery method is not the same. The follow-on processes are not the same.
Yeah.
Yet, and I guess that anyone who really understands, I guess it's just anyone who understands something more in depth appreciates the nuance of something. And every time, if you don't, you just kind of, it's like going to a different country, it's like going to to a different country. It's like, maybe just different language, and I just wanted to highlight that insurance always requires, to be successful, an adjustment of the products, the processes, to the specific channels. Sometimes they are larger, sometimes they're smaller. Just wanted to kind of highlight that. You've mentioned something on the side of when you mentioned health insurance, and just for the sake of not everyone having English as the first language you're listening to, when you say we use health products as a rider, could you just elaborate what that means? Because sometimes, even in English, the UK might use a different term than the colleagues from Australia or the United States, and so we just understand that terminology.
Yeah, so often you would get, and also in my scope, right, working with Europe and Asia, but also within Asia, India and Vietnam would be very different markets from a product perspective. So often in life insurance, you would have actually very similar product or very simple products. A term life product would pay out if you reach a term, right? Or if you die within the term, then you would have a different type of product. But that's only ensuring your death, right? And some of the riders offer the opportunity to have coverage for different types of risks as well, which means, for example, you could add a critical illness rider on top of your life insurance, which does not only pay out if you die from a critical illness, but if you get hospitalized or if you are diagnosed, or a cancer rider would cover you for certain cancer types. And those are often then sold on top of a main coverage, which is often a life insurance coverage. And yeah, those would be naturally smaller, simpler products, though quite hard to say simple when you say critical illness and we list like 100 diseases, right? So it's not simple necessarily from the customer perspective, but a rider would be a sort of attachment, right? An extra coverage on top of your base cover, basically.
And because I think it's interesting, I just want to kind of dig in because it's sometimes, as we've alluded, product development is key in making some of these distribution partnerships work, B2B2C partnerships work. In your definition, is it different from product development perspective, attaching a rider to a product, or let's say opening up the product itself and adding such coverage as an integrate module to the product? Because or is it just terminology and it doesn't really matter because you technically it could be very different, right? And
Yeah.
it might be different in terms of, have I now sold 2 products?
Yeah.
Or one? And it'll just be interesting whether I'm making this overly complicated or whether you've might highlighted, let's say, a fast lane to product adjustments than some pure play agent broker type product managers might normally look for.
Yeah, I think riders are very important for your agency channel, because once you sold basically a core product, a core life insurance product, adding a rider you can do anytime during the lifetime of the contract, right? So that's always an opportunity for the agents to reestablish a relationship and go back with an extra point of contact with the customer. I think selling riders online in a digital space is not that obvious, because online you don't have, you need to be very clear to the customer on what are they buying. And the more extra features you try to stuck in to your product, it will be just even more difficult for the customer to grasp what they are buying into, right? And that is super important to avoid any bounce back from a customer feedback perspective. And so in digital, we have a couple of successful use cases about attaching riders to core insurance products in credit life, for example. So we have in Turkey, via our life insurance company, we have a really nice digital loan journey, which includes an embedded credit life opportunity where you can add, for example, an unemployment cover on top of your regular credit life. And that again is explained in very simple terms. It's clear to the customer. If you die, the loan will be paid back by your insurer. But should you encounter temporary issues because you get unemployed, the additional cover will cover you for that for 6 months or something like that. So you can relatively easily explain that. And in those setups, a rider could work in digital. But that, of course, one of the other learnings we have is it depends really also on what's the target segment you are talking to and what's the literacy of that segment. Because sometimes even the simplest products have to be very simple and very clear in terms of language. And you just have to avoid any sort of distraction, depending on the customer base on a specific platform, for example.
Understood. Thank you so much for elaborating. I think it's interesting that as you venture into, let's say, less advisory driven processes, you might encounter a more restrictive data set, either a more restrictive or a different data set. And so you need to kind of figure out where you might shortcut something, where you might create proxies, potentially where you ingest additional data.
Yeah.
But then also, I think in life insurance, and it's not my forte, I'm kind of coming more from the P&C background, but it's also then interesting that you might restrict certain coverage to kind of accelerate people through the process, assuming that someone, you might have a different, let's say, term that you propose something, but then they're in, and once you have the customer, you can potentially build them up because the level of, let's say, engagement propensity when you are more opportunistically driven is just shorter than when you kind of, okay, right, I got to deal with this insurance thing now. And whether it's half an hour, 45 minutes, or, I'm sorting this out now rather than, accidentally going in. Okay, that makes perfect sense. And it's very interesting. But it shows that you just need to adjust these by partner somewhat.
Yes. And maybe that goes back to your question on, or the topic we discussed in the beginning on products for channels, right? Also within the channel, depending on what type of partner you are talking to, your prices might not be the same, right? So let me explain. For example, in India, in the B2B2C channel, India is our flagship market, if you want, with the B2B2C, where the market itself is just amazing. It's really built around open architecture. So you don't really have that, exclusive partnerships are not a thing. It's everybody's open to partner with everybody, and it's a relatively normal way of doing business in insurance as well. So a lot more experimentation, I think, than I have ever seen in any other markets across Europe and Asia. And in India, also given the size of the market and the city versus rural areas difference in terms of also customer literacy, but lifestyle and way of living, there are very different types of banks, right? So you have tier one banks that would be your traditional banks, but you also have microfinance institutions that are really targeting lower or low to low income segments to at best mass market, but nothing above that. And of course, for example, the loans these players would give in a traditional bank or a microfinance institutions are also very different ticket sizes, right? So a loan amount would be very different. And hence your credit life cover also needs to be different, right? Your not only your risk is different in terms of the tenure of the loan or the amount of the loan, but the end customer segment is also different. So even though the product per se, from an actuarial perspective, you're still insuring the same risks, right? You insure the outstanding loan amount at the point of death if the customer dies within the loan tenure. It's the same risk, but it requires a very different approach in terms of pricing, simply because of the fact it's a different loan and it's a different target customer segment. So your inherent risk will be different.
So coming back, and as I said, one answer, I'm not coming back to the original questions. If you break down B2B2C partnerships, what verticals do you cover under those? What is kind of in scope? What is intentionally out of scope?
Yeah, so we started with, I think very logically, with banks, right? Because for us, that's a no regret move, pretty much also in comfort zone. And we have a lot of assets to build on and expertise, right? So, yeah.
But one thing just to note for our listeners, bank assurance is absolutely part of B2B2C and
Oh,
embedded
yes.
insurance. It's absolutely
Yes. Yes.
because traditionally some companies are like, no, bank insurance is something else because that's traditional, and embedded insurance is kind of go play, but not with the not with what we know that works. Okay.
Yeah, so I really distinguish traditional bank assurance and B2B2C banker. I think that the two are different because, and that's maybe something that you would call Banca 2.0, right? But I think for us, starting with banks is a no-brainer because many of our partners, if not all of the partners, are going through the digital transformation that all of the banks have been going through the past years and even in some markets a decade. Um, and their digital transformation also pulls us with them on the digital transformation journey. And that goes about, simplifying your products, making your documents easily readable, creating customer journeys that make sense. And that can be embedded, that can be standalone digital, that can be a hybrid journey or an O2O journey. It doesn't really matter, but it requires specific reflection. So for us, certainly bank is a no-brainer. From there on, it's relatively easy to scale into payment providers, wallets, like how I explained, microfinance institutions or other institutions who would disburse loans. So I think those were really stepping away from our comfort zone. Those were the players that we were looking into. Mindset-wise, our approach has always been no bespoke development. We try to standardize whatever we do on the product, the journey, the tech enablement, because you have to scale and you will only be able to scale at a low cost if you don't do bespoke and similar funny things. And if you don't do bespoke, that doesn't mean you don't white label, right? But the core behind the facade needs to be very easily scalable. And that's basically something that I'm really proud of that we did, because now we reached a scale where in India with our first projects, we come to a stage where we could onboard 6 new partners in a month, and we can decrease partner onboarding time to something like 48 hours. And I always said to the teams, we did a good job on the asset development and the capability build if it takes a lot more time to agree on a distribution agreement for the legal teams than for the tech teams to do the integration, right? And we are there, right? And that's the place to be. So then we can easily scale into a wider potential partners within digital financial services. And I do count banks, neobanks under digital financial services. And then from there on, we ventured into different verticals. For example, we have some experiments around telcos and telco O2O or hybrid journeys with lead generation and sales conversion via agents. And we are looking at e-commerce opportunities as well, which is there again a slightly different story because less embedded and more standalone digital sales, which means you often end up in a marketplace, right, where your product is one of many or numerous at least. So there, I think the success is really dependent on the marketplace itself, how they bring the traffic to the marketplace and whether the right traffic is there for your product to convert. So I think past 3 years, we really focused on digital financial services, e-commerce, telco, and mostly on embedded standalone digital sales, and started a bit of first experiments in the omnichannel or hybrid journeys as well.
What I'm not hearing is travel or mobility OEMs. Is that because it's not which are also big embedded or
Yeah,
B2B2C
yeah.
channels, but it's not
I
something.
think there's two main reasons for that. I think obviously we started, and that's something I have not mentioned yet. I I only work with the countries where there's a strategic intent and where there's an opportunity for scale, right? Where the addressable market is big enough. And those tend to be our markets where we are present in life insurance. So I cannot look at PNC, right? Because in most of the Asian markets, like the ones we started with, India, Vietnam, Singapore, we are primarily in life insurance. So you have to be very creative then. Second reason is, I think today, if you look at travel or OEM, I think those are pretty red ocean places to play in, and there are really good companies out there who have been there, done that quite well, and they started a lot earlier than we. I don't think that's the place where we have the highest chance to win,
Mhm.
you know? So we follow a really selective strategy where we believe that we have a chance to win because we have either the right expertise, the right assets to build on. Um, and those are really important ones that I don't want to do just anything in B2B2C, but we really defined what is the area that is of value to us and where we believe we can make a difference.
Um, if we're kind of moving towards how do you define success from, I think
Yeah.
the local entities, it's pretty clear, right? It's premium and profitability, etc. How is what does success mean for you? How do you work with your partners, and potentially if you who pays for your services?
Yeah. So I think it's super important, but it's also quite strongly linked to the operating model we build. So I am at Ageas group level. I don't have an operating company my own, right? I have 13 markets across Europe and Asia, and around 5 or 6 of them have explicit B2B2C channel development in their strategies. I think every market would look at it opportunistically, but around 5 or 6 that are the ones that are really focusing on this opportunity and are moving forward with priority. So from the group level, I have a small squad team, and we developed a couple of capability partnerships, if you want. One with eBautech for easy connectivity using their InsureMo platform. So that's really to have the right products available in API version, right? As well as with EPAM, who are helping us as our sort of external IT team, if you want, to be able to scale up and down and launch products across the different markets. So basically, we work hand in hand with the local operating companies, depending on if it's a new product launch or if it's a new partner launch, or if it's just a new journey with an existing partner. These projects can be small or quite big. And of course, the related KPIs will also differ. So what matters to me is what's the business value we are creating. So obviously in the local balance sheet, what's the inflows we are generating, how many lives are we insuring, if we are measuring, is there a customer NPS linked to the journey and the process. And then, of course, the product that we are launching profitability, though it's not obvious to measure channel profitability from day one, but because you still have some upfront investments that you have to make. But the products that we put out on the market are these priced profitably. And then for my own KPIs, right, for my team and for the capability side itself, our approach is that we invest in reusable assets, which means we develop once and scale to many, right?
Mhm.
Instead of having all the 5 priority operating companies in, developing the same stuff?
Mm-hmm.
Can we do it once and then scale it into yet another partner or yet another market? And those are the reusable assets that we are looking into and capabilities. And that's what my team basically is developing and delivering on. So my KPIs are around number of assets, number of times we have reused, unit cost of a project launch, because ultimately the smarter you get, the cheaper it should be, things like that. So this duality exists. Of course, we measure once the business impact we are making, as well as the, let's say, the IP, the intellectual property we are developing for the group itself. So the both to go hand in hand.
So what I think is interesting, I want to kind of point out, simply because of so many conversations that I've had, I think it's number one, that you decided that B2B2C requires its own technology stack that is geared towards rapid product development, easy integration, and usually branching across product lines and countries as well in your case. And the second thing, and it makes sense because it's I think because you're building for the partner, there is a certain analogy that whilst, let's say, motor insurance is different in Germany than in India, and having the same stack, digital bank assurance probably is actually reasonably similar in the way you outsider need to design the products and the kind of restrictions that they provide on you. And the second thing, and I thought that was also interesting, that you have access to flexible capacity, so to develop. So it's important to have a technology stack that you can quickly, I guess, train people, or have a provider that is trained on the platform that can easily scale up and down, because you yourself don't know exactly when the delivery time points happen, because they're subject to deal flow. And I'm just pointing that out because this is not something that actually goes counterintuitive to what a lot of, at least European companies in their IT transformation, where they go, let's put everything on Guidewire. Or, let's re-platform on our core business and not just another system, and let's standardize products. We want to reduce product complexity, etc. And I think it's just something, to me, I'm hearing, if you want to play in the B2B2C space, you need to make sure that your go-to-market has the right tools at hand, and they're somewhat different than optimizing an existing business from your agents and brokers.
Yeah, I think our ingoing assumptions has always been that, we've seen some successes and failures on this market. And I think behind the failures, quite often we see that companies just want to own the tech stack and would pump in a lot of money and resources to develop their tech stack. And I sort of intellectually get it, right? Because you remove dependency whatsoever. But I think it's increasingly harder, and you also talked about it, the talent war in one of the other episodes. The talent war is just super hard, and I don't think it's easy for an insurance company to develop their tech stack and be able to be on top of the curve when it comes to technology and attract and retain the talent to keep up that tech stack readiness as well. So I think for us, the partnering is a super important building block in our approach in this, not only because it allows us to scale up and down, but it still allows us to develop our own blueprint. So we know how a product launch MVP looks like. We know what's the stack, what's our approach, how do we build up a project, how do we deliver it on time and on budget. It doesn't have to be all internal resources, because whoever is on the project follows our own blueprint, and it gives us also the opportunity to be flexible and and for us, it has been working perfectly, really.
And I think one interesting thing about this, it's not when we kind of, I think within the space of B2B2C insurance, where you of course want to have standardized scalable solutions, but sometimes there's this other party who might just look at it differently, and you on the first partner, you might not yet know how much of it will be standardized as you scale this to the 10th partner.
Yeah.
And I think, as we can all appreciate, it's a continuum between total bespoke and total standardization. And I think it's just helpful stressing that with more and more use cases. If you as an organization have the stomach to do that and go through it, great. But usually, at least I don't know, under time and budget constraints, people usually don't build it more flexible than it needs to be, because as you build in flexibility and modularity and variance, you add time and cost to it, right? It only pays off later. And so I feel partnering with people who believably have gone a little bit, and you might actually benefit from other partners stressing, it is, in that particular context, I think, also logically or theoretically sound, not just practically.
Yeah. Well, let's reconvene in 3-5 years, and I will
and
I will give you an update. But
exactly, and hopefully the technology then didn't go bust or was bought by your worst competitor. There's other things. Conscious of time, is there any kind of topic or aspect about B2B2C growth engines and the things that you deal with day to day that we weren't able to touch on, but you would like to do so?
No, I think we pretty much touched upon everything. But if we had another hour, I think we would easily fill it in, Nick. So generally I'm super open to any requests, or if somebody would want to reach out to me, you can always find me on LinkedIn, and happy to continue the discussion basically anytime. Believe we also learned a lot from industry peers, success cases, or failure is of course a word that many hate. But there are some failures out there, and as long as we can talk about it, is fine. So pretty much open to learnings. If anybody would want to share, happy to hear.
I could just recommend that anyone do so, because it's not just lip service. You've been great on stage and off stage, or online and offline. So thank you so much for your candor and your insights. I wish you all the best in continuing to deliver. And thank you so much for your time.
Thanks, Nick. Thanks for having me.
Take care. Bye.
Bye-bye.